Hey guys, thank you for tuning in. This is our live session for the investment strategy for VFA fellows with our very own investment expert of Cleveland, Jeffrey Stern. Before we start, I would like to give a shout out to our sponsors, Humanlytics. Humanlytics is a AI platform that's designed to make data analytics easier for small, medium-sized businesses, starting with Google Analytics. So we are making a Google Analytics tool that both educates and using AI technology to make data analytics easier for all businesses. You can learn more about Humanlytics at humanlytics.co, or you can simply email me, Bill Su. I'm the CEO and founder of Humanlytics, at bill@humanlytics.co. You guys probably also, most of you have my number, so reach out. And if you have any questions about digital marketing analytics, please feel free to let me know. I'm more than happy to help. Let's go to the topic for today. So this originally was conceived as an investment session for Cleveland fellows only, but I figured that it will be a great opportunity to share investment strategy with everyone in the VFA community, because this is actually quite important. Money management is quite important given that we are not getting a lot of salaries from the VFA program either. So today, we're going to primarily structure the session into three parts. So the first part is we're going to talk a little bit about Jeff and Jeff's experiences in investing and what sessions he have. And we're then going to discuss two very experienced and popular investors for nowadays. So one's Warren Buffett, who is known as the Oracle for Omaha, who is obviously one of the richest person in the world and made a lot of money from investing. And the second person will be Jeff Bezos, who also took a very wise approach in investing, and which made him a lot of money. And he's also right now obviously CEO for Amazon, one of the largest company in the world. Yeah. So yeah, without further ado, let's get started. So Jeff, why don't you just give our audience a brief introduction of yourself?
Sure, and I'll start by thanking you for forcing me to do this, but I'm happy to partake. Also preface by saying that I'm thoroughly underqualified to be providing financial advice beyond the scope of the experience that I've had personally. So take everything I have with a healthy dose of skepticism, and I think we can all benefit from a conversation talking about this stuff. Yes, so I'm a 2016 fellow as well, and Bill and I are roommates together, and welcome to our humble abode as well. So yeah, that's a bit about me.
So Jeff, how did you get into investing?
Sure. So let's see. It goes back to 7th grade, and it was kind of by chance that I got involved. I was kind of forced involved, actually. Our school was doing the New York Stock Exchange game, which is a game where you are provided virtual money, and you invested in the market. And really, by luck, I ended up winning for New York State.
Oh, wow.
And so with that, I got to go to the stock exchange. They brought me to school for a week. I got free ice cream. And it all very much turned me on to the idea of investing. Mm-hmm. And at that point, I convinced my parents to give me a bit of money to start investing on my own. And for the past 10 or so years, have been managing my own money because of that experience.
Wow. So if you can summarize like everything you learned in investing with one sentence, what would that sentence be?
Yeah. It would be to do it early and do it now. So the biggest thing that I've learned after having lost, full amounts of money in investments that I made and made a lot of money in others is that, and it's something I think that kind of sounds easy when you first hear it, but didn't really click until I experienced it personally, was that the worst you can do is lose the money that you put in. Mm-hmm. So if that's $1,000, the worst you can do is lose $1,000. On the flip side, the best you can do is unlimited. And how that really translates into real life was if you were to go back to 1997 and have invested in Enron, you would have lost all your money. Enron was a scam. They went bankrupt and, defrauded all their investors. You would have lost your $1,000. Mm-hmm. On the flip side, had you invested in Amazon in 1997, your money, that $1,000, would now be worth around $500,000.
Oh, wow.
Which is crazy. So we'll get to Bezos and why that happened, but the fundamental idea that I've learned, I think, over just having been in the market is that most of your returns will outweigh any of the losses that you have, just because as investments lose money, they become a smaller percentage of your portfolio.
Mm-hmm.
And on the flip side, the ones that do really well become a larger percentage of your portfolio, and they have the room to grow kind of infinitely.
Yeah, I remember we were having this conversation yesterday that you said that if you have like $10 million that you're just putting in investing as interest, then every year you get like $100,000, and that will be a salary of like a normal working person. So just start investing is obviously it's very important for all of us just to get started going, because of the law of compounding will enable us to just keep going, make so much money in the future, even if it's just like a few percent of return in the beginning. Thank you so much for the suggestion. That's great. And I guess, so can you just, I remember when we are doing preparation for this interview that you have 3 principles that you hold yourself to when you're investing, or 3 lessons you learned during your experience in investments. Can you just elaborate on the 3 things that you learned from your investment experiences?
Sure. So I've already kind of alluded to some of them, I think, but they are essentially that time is the largest factor contributing to your success as an investor. So it's not how smart you are, and we'll kind of get to Buffett's take on this, but it's really just the fact that you're in the market at all will determine your long-term success.
Mm-hmm.
You don't have to be a Warren Buffett to do quite well over the course of your life.
I see.
Which is why I'm such an advocate, I think, of starting right now, when I had to distill my thoughts into one sentence. And that's really because of this thing that I've learned. So, you have a chance to potentially make a lot of money overnight if you were to, luckily kind of pick something that popped. But
I see.
Because of this compound interest that you mentioned, and there's a reason Einstein called it even a greater discovery than nuclear physics.
Yeah.
The longer you're in the market, the better you'll do. And the longer you're in the market, not only the better you'll do, but the better you'll do later in life.
I see.
So the returns that you have today will amount to something, but the returns that you'll have 20 years from now will be exponentially greater.
I see.
The other one was that point about the worst you can do is 100%, but the best you can do is unlimited. I think it kind of speaks for itself with the Amazon scenario. $1,000 had you invested when Amazon went public is now worth $500,000.
Yeah.
And the worst you would have done had Amazon failed was you lost your $1,000.
I see.
And then lastly, it's to ignore any kind of noise. So, people, you could turn on, Fox Business every day and hear them talk about the market, and all the Wall Street folk and the analysts. But at the end of the day, there's this funny thing about Wall Street where they have expectations that companies will beat expectations,
mm-hmm.
which is kind of fundamentally flawed if you think about that, right? That doesn't make any sense. But that's what they do. And they'll talk about stocks every day, and they'll, what happened to the price of iron and how that affects all this nonsense. If you ignore that and you invest for the future, when you're 80 years old, you will do a lot better off.
I see that principle especially resonate with me, especially when I'm in the data science industry, where you're talking about distinguish noises from the signal. So sometimes business owners or people would see a short-term rise or fall in traffic, whereas it's actually just an illusion, where it's just like a boom bust cycle that probably is caused by seasonality or some like very short-term time series impact that's not because they're actually doing very well. And if that boom bust cycle exists, it sometimes can be elusive that you think your business is growing or falling, but in fact the long-term trend is actually going up or down very differently from what you perceive. So I definitely can see that having a long-term perspective will benefit a lot for people who are not very familiar with investing or like data analysis.
Yeah, it's also less stressful, right?
Yeah.
If you don't have to think about your money and your investments every day, then you're not thinking about it, and you can focus your time and attention, where you probably are getting better returns from it, and you just I think I'm a kind of a weird exception in that I enjoy this stuff, but I think most people don't really care for it, and why would you want to spend your time worrying about something that you don't care about? If you ignore the short-term noise, you don't have to care about it.
I see. Awesome. And I guess another question is, for some of us, I guess it apply only for like very few of us, but it's still a good question to ask. So what if, like, I'm very busy, for example, like I have a small amount of money and I want to just have like a professional investor to invest it for me, even if it's like a small amount, like maybe a bank, maybe something else. What was your recommendation there for someone who just want to give someone else the investment power for investment?
Yeah.
Money?
There are a few things that are important. The two that come to mind as the most important are related to fees.
Mm-hmm.
So most money managers will charge a fee for managing your money, and you obviously want that to be as low as possible and close to zero. So typically the range is from like 0.5% to 2.5% for like really actively managed funds, like a hedge fund or something.
Mm-hmm.
And over the course of your life, which is how long you should be investing, even though it doesn't sound like a lot, like a 1% difference in fees, that could amount to hundreds of thousands of dollars going to your manager rather than to yourself.
I see.
Just because of fees. Forget returns, forget any of how your own money's doing. Just because someone else is managing your money, and it does well over time, that 1% could make a really big difference down the line, and so it's something you kind of want to consciously be thinking about.
I see.
The other thing is a legal term called fiduciary. Essentially, a fiduciary is to finance what being a licensed doctor or a bar-sanctioned lawyer is to law and medicine, respectively. It ties them. It ties your incentives to their incentives. In the same way that you wouldn't want an unlicensed doctor operating on you, you don't want a non-fiduciary manager managing your money, because then they're incentivized, frankly, to maximize profits for themselves through trading fees, any type of fees. But if they are a fiduciary, then they're legally obligated to have your own interest in heart, which obviously is what you want. The funny thing is that money managers are not required to be fiduciaries, whereas doctors are required to be licensed. So you have to ask your money manager, like, are you fiduciary?
So we need to be careful when we're selecting the money manager, or it will be a problem. It sounds like
right.
There'll be potential risk down the line.
But then on the flip side, I don't know how many people will actually have a personal money manager, at least at this stage in our life, on our VFA salary.
Yeah.
So just kind of focus, I think, on the fees aspect if you're using a robo-advisor or something like that. But just be, consciously thinking about the fact that fees actually matter.
So someone asked, what is a fiduciary? Can you just reiterate and explain again what that is?
So a fiduciary legally ensures that your money manager is acting on your best interests, in the same way that having a doctor being licensed ensures that they're acting on your best interests as well. And so if they're not a fiduciary, the analogy I like to draw is like a non-fiduciary is to finance what Dr. like Phil and those guys are to medicine. They don't really do anything, and they just kind of spew nonsense, and they maximize their own returns. And they don't have your best interest in mind. They're trying to push something. They're trying to sell something. And the equivalent on the fiduciary side is they'll trade for transactional fees, and ultimately it's not your investment that they're trying to grow. It's their own income.
Okay, thank you so much. So I guess that concludes the first section where we are talking about suggestions from yourself, your experiences. But I do understand that you're a huge fan of both Warren Buffett and Jeff Bezos. So let's get into either of those people and then talk about the investment suggestion strategy we can get from them. And also for those who are viewing, if you have any questions, please feel free to type into chat. And please no troll questions. I'm seeing some, and let's keep the chat positive. And so let's talk Warren Buffett.
Yeah. So Buffett is a brilliant dude, very smart man, keeps a very low profile for how wealthy he is relative to a lot of others, and that's just his mentality. He's kind of also a no-nonsense guy. Yeah. And the lesson that I want to highlight from him was, so every year he puts out these annual shareholder letters to anyone who's a shareholder of Berkshire Hathaway, which is his holding company, which is how he's amassed his wealth over time. And back in 2005, he basically wrote down on paper explicitly kind of these thoughts that he had been thinking about for a while related to how an average, non-involved, passive investor like you or Bill or anyone else would do against a group of hedge fund, smart, high IQs, like people who spend their lives trading and actively investing their funds. And he theorized, and he actually put a $500,000 prize, a bet, that us average passive investors would do better than the actively managed hedge funds over time, over a period of 10 years. So what actually happened was there was a ballsy enough hedge fund guy to take them on and took the $500,000 bet, and the bet is terminating at the end of this year. I see. And the results are pretty much in, because it's been the 9 years. Over that period so far, the actively managed funds, the ones where you're paying, that high end 2% a year, have returned 2% a year. So quite literally, all of the money that you would have gained would be paid back in funds. Alternatively, the market fund, us passively managed investors who just put money into the market and forget about it, would have returned 7% a year, which is on average what the market should return. And so Buffett has obviously by far and away won this bet. But the important thing, and it goes back to the fees aspect, is that not only did the hedge fund guys underperform the market, you on top of it are paying fees. So even if the hedge fund people had done average, which they didn't, they did below average, which is really kind of ironic, you still would be much better off in a passively, not actively managed fund because of the fees. So the fees matter. The fees matter is the point.
So when, for example, what is the takeaway from this? I guess if I have, for example, $10 million and I want to invest in this, if you say that hedge funds probably not the best idea to go, so where should I invest? What should my portfolio be in terms of investment?
Yeah, so it totally depends on, this is kind of a wishy-washy answer, but it'll depend on your affinity to risk and how comfortable you are with different strategies. But at the end of the day, if you want a riskier medium of investing, you're almost always better off empirically, as you've kind of seen through this study, but there's been hundreds of others that kind of look at the performance of actively managed funds over time and how they underperform the market. You're almost always better off, if you're comparing those two specifically, taking the passively invested approach.
That makes sense.
If you're comparing those two. Obviously, you can take different approaches personally based on your own preferences, and you could try to pick, but you have to know kind of what you're willing to lose.
I see. So let's go to Jeff Bezos. I'm personally a fan of Bezos as well because he's one of the pioneers for internet businesses, which is what we are as well. So what can we learn from Jeff Bezos? Because when you talk about Jeff Bezos, he sounds like he's not like a big name investor. He's more like an entrepreneur than someone who does finance or banking. So what can we learn from him?
Yeah, so what you can learn from Bezos is the notion of long-term thinking, which from an investing standpoint is kind of what I think is the most important aspect to it, because like I mentioned earlier, if you're kind of focused on the short term, you're going to make decisions that likely have kind of adverse effects on your long term. And so what I love about Bezos is that back in 1997, when they first went public, he put out basically his entire thought process for how he wanted to govern Amazon and its growth and its development over the course of Amazon's lifetime for the foreseeable future. And he tells you in 1997 exactly what they're going to do for the long term, how they're going to focus on customers, how they're going to reinvest profits, how they're going to basically take over the world. He talks about it, right? The vision is there, and how he wants to operate this company is there. And he says, and this is to the point that I made earlier about, Wall Street expects companies to beat expectations, which doesn't make any sense. Forget that. That stuff does not matter at all. If you focus on, the long-term success, creating value over time, then you are setting yourself up for success. If you're trying to maximize your profits for, 2 months out, how is that going to help you for, 20 years down the road?
I see. That makes sense. So one theme I've been hearing repeatedly is the long-term focus. So everything short-term, you might be able to go all in and get the most benefit from the short-term perspective, but long-term, you might be losing. So I think a long-term thinking is what we can get from Bezos in terms of investment. That's very helpful. Thank you. So I guess that comes to the end of our discussion today. So what is some conclusion? So for example, for VFA fellows, which is this session specifically for, what is the immediate thing that we can do right now to manage our money, manage our fund and investment?
Yeah. So kind of putting it all back together, I think the best thing you can do right now would be to get involved in the market, because your success in the market, like I mentioned, it will be largely determined by how long you're in the market, not by timing it right or even your knowledge of it. The way the market has operated since inception is that it's up every 2 out of 3 years. So if you look back over the course of the 100 or so years that it's been around, every 2 out of 3 years it's up, meaning that 1 out of 3 years it's going to be down. And in those years where it's down, you go back to 2008, you go back to 2000 with the internet crash, and the market loses 30%. You could lose, if you have $1,000, you're losing $300. That's significant. But over the course of time, if you're an optimist about the world and all the companies that comprise the stock market doing well over time, and you value any kind of insight you can gain from the past, the market goes up every 2 or 3 years. So long as you are invested over the course of your life, over time, as long as you are emotional about the process, and ultimately don't panic when shit hits the fan and stuff's going wrong and you may feel an urge to sell, if you kind of ignore your fundamental gut kind of visceral reaction to it not doing well, and you just forget about it, you just put your money in and you forget about it, you will be very happy when you're older.
I see. Thank you so much. I guess now we're going to the Q&A session. So there's going to be a 1 to 2 minutes delay between question and when we're able to see it. But just feel free, please type in chat. I see Brandon, you're doing a lot. That's great. We're just going to start answering questions one by one as they come in. So Brandon and Gail ask, what do you mean by passive investment approach? Where will we find a fund like that? Does it have a name?
Sure. So, and this will come up even when through Votum, through any kind of 401k that you're offered through your company, there will likely be a manager who's doing that for you. You should try and figure out if that funds, if the money that they're investing on your behalf is being actively managed or passively managed. It's something you'd frankly have to ask. If you're doing it on your own, you have some money that you're saving every month from your paycheck. Vanguard has, you can just Google it. They're probably the largest manager in the world of these types of funds. Is if you just Google passively managed or just index funds is typically the term that people use. Those are the ones you want, and then you check the fees out, make sure that they're in the reasonable range, which for something like that would be under 0.5%. And then typically it'll come back to the fees, because the actively managed ones are closer to that 1 to 2%.
I see. That makes sense. Another question from Brandon is, how would you suggest splitting up investment into something like a Roth IRA versus just investing in the market with the ability to pull your market at any moment? And given our VFA salary, how would you go about taking like a chunk of your salary out for investment?
Yeah, that's a great question. So first off, I guess we can touch on Roth IRA versus a regular IRA. So IRA stands for Individual Retirement Account. From our perspective as young people in this world and probably to investing, the Roth IRA will make more sense because if you believe that over time you're going to acquire more money, but as a result, you will be in a higher tax bracket when you're older.
I see.
That's the underlying assumption behind this. Roth IRAs allow you to pay your taxes on your investment up front, and then when you're older, take your money out tax-free.
Oh, wow.
So, because we're on our VFA salary right now, we're not making that much money. Through a Roth IRA, you can pay your taxes now at a much lower percentage, unless kind of Trump has his way and all the taxes are lessened. But that aside, ultimately, kind of across the world, if you're more wealthy, you pay higher percentage of taxes. So from our standpoint, assuming that you're going to be wealthier when you're older, you would rather pay taxes now when it's cheaper.
I see.
The flip side, the regular IRA is the exact opposite. So just for reference, you invest tax-free, and that money grows, and then when you take it out, it's taxed.
Oh, I see.
So that's kind of the fundamental difference.
Okay, so we have a next question from Winston Law. Hi, what's the first step to actually put money somewhere?
So one thing I didn't actually touch on yet is that investing is kind of ancillary to the other aspects of how you build wealth. So the way I kind of think about personal finance is that you have the money you make, the money you spend, and what you do with the difference. And what you do with the difference is investing. But most of the money that you save will come from those first two variables, which you can directly control. You cannot control investments. It's the market. It's kind of unpredictable. We know over time, every 2 or 3 years, it's going to go up. But you control how much you spend, and you control how much you save. And so you should kind of focus, I think, on that aspect first. Think about where you're spending, where you're saving, and just kind of go from there. And then the truth is that you kind of just have to start. So, after this, you can go to a Betterment, a Wealthfront, open up an account, link your bank account, create automatic deposits every month for an amount that you're comfortable with, right? So you don't want to sacrifice your quality of life to a point where you're uncomfortable. You need to figure out what works for you, but just go link your bank account to one of those, Wealthfront or Betterment would work, and just take $100 out every month. They'll automatically invest it. They'll even ask you for a series of questions that are meant to kind of gauge your risk and affinity to different types of investing. And then you forget about it. It happens every month. Your paycheck will go down by a little bit, but you've thought about that. You can make it work.
I see.
And then when you're 60 years old, that money will have grown a lot because of compound interest. That's just how investing works.
I see. That makes sense. Thank you so much. We're gonna wait for around a minute to see if anyone else have any questions coming in because the stream's delayed for a minute. So when they hear this, it's gonna be a minute later.
Got it.
Yeah, fizz around. But yeah, so just while we're waiting, this video is going to be made available. Hopefully, if all technology works out, on YouTube, and it's going to be shared with the entire VFA community as well.
Okay.
So
on that note, yeah, I want to reiterate the point that I'm not qualified to actually give any advice on this stuff. Cool.
And I guess Sia, we have another question from boy 216.
Yeah, boy.
Yes. So TSLA Bull or Bear?
TSLA, for those who don't know, is Tesla. So one of the things that now we're going to get more into like my thoughts on investing in individuals. So my personal take is that you invest in the future that you want to see. So for me, it doesn't really matter what the PE ratio, any kind of this numerical, frankly, the Wall Street short-term noise that I mentioned earlier. I don't worry about that. I focus on the future. I focus on the types of companies that I think will affect that future. And then I invest in those companies.
I see.
I think Tesla is going to change the world. I think Elon Musk is a G. And so I invest in Tesla. And I've been invested in Tesla basically since you could. And because my approach to investing is very much closer to approach to venture capital than it is to traditional investing, is I pick the companies that I think have the potential to have a large presence in their respective markets. Mm-hmm. And I pick a lot of them. So I'm willing to kind of lose money in the ones that won't work out. But in a similar vein to venture capital, their returns come from one or two companies that do really well, like the Amazon or the Tesla for me. So I think that thumbs up on Tesla.
Okay. But
being aware that it's right now valued at more than Ford and GM, who sell probably 100 times the cars that are selling. So you're investing in the future. But like all investments I make, I remind you, the worst you can do is the money that you invest, and the best that you can do is unlimited. Yeah. And as it stands right now, Tesla's about a $40 billion company, give or take. Elon Musk believes it's $1 trillion company in the long run. So if you buy into Elon Musk's insanity, there's still quite a bit of room to grow.
Which you do.
Which I do.
Yeah, just a disclaimer, Jeff is a huge Elon Musk fan, so on the subject of Tesla, I'm not sure if his opinion is that of a credited financial professional or it's just personally biased.
My opinion, no matter what, is not of a tenured financial professional.
Yeah. So no matter what. Okay. So Brandon, I have a question. Jeff, can you double back to my second question? It was about splitting investment into Roth IRA, and just investing in market. His question is, if you only invest in low index fund, then what would you suggest investing if you are investing in the IRA?
Yeah. So I'll throw some names out. I'm not a professional, so they're whatever, but the ones that I'm personally invested in are VWO, which is a global index fund. So it's essentially like you take, the idea behind it was you take kind of the GDP of the world by each respective country and you get a piece of it. But it focuses on the emerging markets, so not a U.S. focused one. And so by buying a VWO, which is the ticker symbol, that's what you would look up to actually buy it through whatever brokerage account you have, you'd be getting that type of investment. But other ones are like VOO is their total market fund. So like for the U.S., if you wanted to buy the market, I believe the one you would want is VOO. It's a market index fund for U.S. stocks. But so from there's a whole bunch of other tickers that I'm not sure off the top of my head, but if you Googled them, you would find them. If you wanted only small size companies, or larger size companies, or companies from a certain industry, you only wanted to invest in solar, for example, there are specific index funds that mirror each of those respective areas that you can buy. The fees will vary depending on what they are, but you can do that. And so you have to search, and I'd actually be happy to kind of come up with some that I can think of later. But that's you want to look for index funds.
I see. Okay, this is a question for me from user I love Bill Sue. How do I buy stock in Humanlytics? You can personally reach out to me at bill@humanlytics.co if you're interested, and we can for sure negotiate some terms. And thank you for the love. All right. All right. So there's another question from Winston Law, without a T. Also, any thoughts on investing in real estate versus stocks?
Yeah. So there's a few different ways to invest in real estate. Obviously, you can buy real estate itself. From the investment standpoint, you can buy what's called a REIT, an REIT, which are a type of corporate structures that compose of real estate properties, and they're by law required to pay out, I think it's like 90% of their profits as a dividend. So if you don't have the money to like specifically invest in a property, like you can't buy a house in Cleveland, for example, but you wanted some kind of exposure to real estate, you could look at different REITs. I personally don't. It's a kind of a preference. I like to, like I mentioned, focus on the kind of VC style approach. But if you've felt more comfortable in that space, I think it's definitely worth considering. I don't have a lot of experience, so I'm not totally sure.
Okay, I see. All right, so I think this is a good time to wrap our session up today. Thank you so much, Jeff, for doing this session with me today. This is, I think, is very helpful for VFA fellows. And as I explained, that this video is going to be available on YouTube if all the technology works out.
Yeah.
Which hopefully they're going to be. And also, video is also sponsored by Humanlytics. So what you're on right now is a Humanlytics stream. So in addition to these weekly sessions that we can get friends on, we are also going to stream more like digital marketing related contents by me and my co-founder Patrick Han. And if you guys who are watching right now, who are VFA fellows who want to share anything with the VFA community, please feel free to reach out. I think it's a very good way that we can use this kind of new technology to thank you, I love Belsu. We can use this technology to facilitate communication of knowledges among VFA community. And thank you guys so much for attending today.
Yeah. So thank you, Bill.
Yep.
This has been wonderful. I think it's a good place to start.
Yep.
It's an important conversation to have. People don't like talking about money. But I really think that you're doing yourself behoove you to invest as soon as you can. And yourself later in life will thank you for it.